GDP report came out, which was good, and ended the week with an employment report. So let's start with some good news, and that is, of course, Brian, that the economy has been continued to grow up 2.6%.
Yeah, the GDP numbers for the second quarter were really encouraging, especially when you look at the details. There's been a lot of concern about an economic slowdown, and indeed, things are slowing. But here on our investment committee, we think it's slowing to a sustainable pace. And indeed, that's what the GDP numbers really showed us. One of the things that goes into it is this line item that the Federal Reserve has called out. It's the final sales to domestic purchasers, because there's a lot of things that go into gross domestic product as far as imports, exports, government spending, business spending. The final sales to domestic purchasers is really this almost kind of like, what's the core amount of growth going on? And that was around 2.6%, which is actually very healthy. It's about the median that we've seen since 2010. Now that's off of the 3.5% growth rate that we had last year. But things are slowing, but towards that sustainable pace, and the markets kind of like that.
Yeah, they do like it because, of course, it is obviously not negative. There certainly was a lot of talk for a long time, Brian, about perhaps a recession, and we still haven't completely got away from that. But I always said, as long as we continue to see positive GDP, that we should put that R word aside. And at this point, we still had positive growth. But there's no question that you talked about some slowing, and there is slowing, and it's certainly based upon the economic strata that everyone is in. So
yes,
we're seeing spending, of course, in higher income. We saw Decker, one of the sports-related companies, they had really good earnings. And, of course, because they sell Hoka shoes and in UGG boots, those things are selling. But on the other end of the economic strata, you're seeing most of that money just going for staples. So there's no question we're seeing a tale of two tales.
It is. And it's really interesting if you look at luxury brands. Some of them, especially the European ones, have struggled over the last year because they really were tying their fortunes to selling into China. And China has been going through their own struggles and economic slowdown. And so I took note of a number of these luxury brands like LVMH. You've also got a few of them, especially with the alcohol sales. It seems like they've really cut back in China. But if you're selling more to the high end in the United States, which is one of the examples that you gave, that's where most of their sales come from, they're actually doing pretty well.
Yeah, and they really are, but you have to split those apart and talk about, where things are going. So we got some good information with the PCE report, which is an inflation indicator that the Fed likes to use, and that, again, is headed towards their target. Now, again, remember, folks, it's just inflation is still prices going up, but not as fast. And so we see that right now, and we're talking about what the Federal Reserve is going to do because, there's a meeting coming up next Wednesday. Will they talk about lowering rates? The odds are that they'll talk about it, but they won't do it until September. But there's no question, Brian, there is a big disconnect between the market rates, where they're at right now, and the Federal Reserve rate, which is almost 150 basis points apart.
That's right. Yeah, the Federal Reserve is targeting the federal funds rate, and that's 5.5%. It's actually a range, so that's the upper end of it. But if you look at where it is as far as the 10-year Treasury, even the 2-year Treasury, those are more market-determined rates, as you point out. They are telling the Fed, you should be cutting. I think last time I looked, the 2-year was at around 4.4%. You had the 10-year Treasury at around 4.2. So the market is pricing in the idea that the Fed really should get off of their hands and start cutting rates. And we have gotten enough data. You mentioned the PCE numbers. Those are very powerful because that's what the Fed, their preferred target is, getting to 2%. That came in at around 0.1% month on month. So if you annualize it, that's around 2.4%. So it's heading in the right direction.
There's two things I want to point out. Number one, of course, is that the Federal Reserve is likely to lower rates, which the market has been waiting for. There's no question about that. And the second thing is you started to talk about where the interest rates are. We spent a lot of time over the last couple of years talking about an inverted yield curve, and we certainly have that, but it's starting to uninvert.
Yes, it is. Yeah, and that's actually due to a number of factors. One is, growth is okay. So you have kind of those yields on the longer end, the 10-year. It's around 4.2% or so, which is pretty consistent with where we would want it to be, I think, over the long term if you're getting 2 to 2.5% real economic growth, and then you tack on a little bit of inflation compensation onto there to get that 4.2%. But you're seeing that short end begin to move down, and it will move down in step with the Fed as they start to cut. Now, one of the things that's also pushing up that long end, though, government debt. Right? There is just a lot of it out there. The budget deficit around 1.7 trillion. Maybe it's going to get down to 1.6 trillion. It's around 6% of GDP. Until that gets under control, you're probably going to see those longer term yields continue to move around quite a bit and stay elevated relative to what they would be if we got our fiscal house in a little bit better order here.